The S&P 500 is down 22% for 2022. That is the biggest drop in the S&P 500 in the last decade. Now, like everyone else, you're probably wondering what is happening in the stock market, and is it now the right time to be buying into the stock market? That isn't a wrong logic, but there's always an element of timing involved. If you get in too early, the stock market could of course continue dropping against you, and that of course will lead to losses and being potentially tied up in stocks you don't want to be tied up in. So in today's recording, we're going to do a deep dive into the S&P 500. We're going to open up the charts, find out exactly what is happening, and look at where would be the best time to potentially buy into the stock market or even short the market, because ultimately in today's day and age, we have some wonderful investment vehicles where we can actually short the stock market if a bear market materializes. So if you like today's videos, guys, don't forget to like, subscribe, hit the bell notification. My name is Zahir Anwari. I'm a co-founder of Sublime Trading. We've helped hundreds of private investors over the past 10 plus years learn to profit from trends in the market through our simple to learn methodology. I also write for a number of publications, including benzinga.com, and I'm regularly invited to guest speak on our expertise here at Sublime Trading, which is trend following and how everyday people can supercharge their stocks performance with a particular focus on the next 3 to 5 years. Okay, so let's get into today's recording. So this is my TradingView platform. This is the charting package that we use here at Sublime Trading. Why TradingView? Well, it's just brilliantly priced and it's browser based. A lot of benefits that come with using TradingView. We've also developed a number of bespoke tools that can be used within the platform. So it's a very, very nice package. So if you're not using any charting packages at the moment, we highly recommend TradingView. We've used various packages over the years, from the cheap to the free to the absurdly expensive, and TradingView is that nice middle ground where it has all the functionality, it's browser based, and it's very well priced. So if you're new to this recording, first time you're watching me, this is a typical 3-screen setup of ours here where we conduct our analysis. In the top left, we have the monthly time frame. In the top right, we have the weekly time frame, and down here across the bottom, we have the daily time frame. We like to look at the higher time frames because it gives us a much clearer picture of what price action is actually doing. Often people day trade particularly on the lower time frames, 5-minute, 1 hour, 4 hour time frames, and although that can work, it's stressful, it's inconsistent, it's time consuming, you're glued to the screens, and ultimately it's a lot of work for very little profit. By moving on to the higher time frames, you have a more investment style where you're actually doing a lot less work for a lot more profit, particularly when you embrace compounding. So the higher time frames are extremely beneficial, and so we're looking at the S&P 500 here, and we're looking at the higher time frames, the monthly, weekly, and the daily. So as always, we start with the monthly and then work our way down to the daily time frame. So I'm going to open up the monthly time frame. First of all, very clearly the S&P 500 has been in this long-term bullish trend since the low of 2009, that's March 2009, to the high which is January of this year. That move, you're looking at a move of around 600%. That's a huge run. Now, of course, during this run to the upside, there have been periods where the market's declined, where it's gone through periods of correction here and here. There was, of course, COVID that we had to deal with at the start of 2020. All of these corrections and declines have all been absorbed into this long-term trend. At some point, a decline is going to be larger than all the other previous declines that came before it. And that's where panic starts to set in. If we actually look at this decline since the start of the year, you're looking at, as already mentioned, 22%. This is one of the biggest declines in the last 10 years. If we actually look at the decline around COVID-19, it was actually larger, with price declining to 35% at the low of that decline. But we're going to kind of ignore the decline around COVID-19 because that's a black swan event. This isn't a sort of natural movement to the stock markets. After every move, the market tends to pull back and correct and consolidate. COVID-19 was a black swan event. We had a huge decline in 2 months, but that was rapidly absorbed into the market. And from that low, to the high of where price is, you're looking at at the high of the start of the year, you're looking at 120% run. So that's a big move to the upside. After every move, the market likes to consolidate or correct, and that's basically what we're seeing at the moment. The question is, how much further can price drop? Ultimately, that's down to price to dictate. We can't ever sort of predict or guess that, and we don't want to, because that's how losses are made and how you end up taking positions that just end up going against you. You may end up having capital tied up in positions you don't want to have capital tied up in. Patience is a huge skill to investing, and a skill that's often underappreciated in the search for quick riches. There's times that you make money in the stock market, and there's times where you stand aside and protect capital. It's not like in employment, where in employment you are paid a salary, which is per hour, per week, per month, per year. You're very clear on what you are going to get. It's ultimately a transfer of time for money, which is all pre-agreed in a contract. In the stock market, it doesn't work like that. In the stock market, you make money in periods, which could be 6 months, 7 months, 8 months, a year. Who knows how long that period is? Again, that's dictated by the stock market. But then there's periods where you don't make money because the markets are going through a correction, they're going sideways, and that's really where you want to be protecting your capital. Because financial literacy isn't taught to us through the schooling system, ultimately what people do is they try and mimic a salary, which is what they're getting in their job, to extracting a salary from the financial markets. And that's a huge mistake. We've got to focus on what the markets are telling us, milk the market for everything that it's giving us when it's in trend, standing aside and protecting our capital when it's correcting. So again, going back to what price action is currently doing, it is correcting. Now, if we look at the month of June, if I just expand the chart, the month of June is actually trading below the low of May. So I'll just mark that on there for us so we can see that this is the low of May. It's not very accurately done, but that will do. That's the low of May, and we can see that June is currently trading below the low of May. How it ends the month, that'll be interesting, because the bulls could come in, push price up, and the closing price could potentially be above the low of May. That'll be positive, because that could mean that this is holding strong as support and we could see a strength to the upside. Ideally, we want to see the bulls come in strong and push price back above that 4,000 round number. Now, round numbers are zonal areas. They're not hard levels. Price tends to come around these levels, form some kind of base, and then potentially move in a particular direction. The fact that we're seeing such a big drop halfway through June is not a reflection of what we could see by the end of June. So we need to apply a bit of patience here. The other point to note is that this red line going across the screen, that is the low of last year. That's the calendar year, January to December 2021. This is the lowest point of last year. This is also a major area of support. Price would come to this level and bounce off it. So for now, if you are looking to short the stock market, you've got to be aware that there is a major area of support directly below the current price of June. And if we move across the weekly time frame, we've also got the weekly 200 moving average for price to deal with. This black line going across the chart, if you're new to technical indicators, this is the 200 simple moving average. It gives us the average of price over the last 200 weeks. Why do we use the 200 simple moving average? Because it's a proven indicator of the long-term trend. Old school traders used to draw charts by hand, so they were very selective with the information that they put on the chart. The 200 simple moving average was a proven indicator of the long-term trend. So if price was above the 200 SMA, they would go long. If price was below the 200 SMA, they would go short, and they wouldn't go against this bias. So the fact that price is dropping is interesting, but it's still above the 200 simple moving average. So the overall bias of price action is bullish. Even though the short-term trend is bearish, the overall bias is bullish. And that's where we got to be a little bit careful, because we want the trend direction and the bias to marry. So we want the long-term trend to be bearish, and we want the long-term bias to be bearish. And that will be confirmed when price is below the 200 simple moving average. Now, if we go back to Corona, which was this drop here, we did have a temporary drop below the 200 moving average. The trend filter turned red. This is one of our proprietary indicators. You'll notice that there's periods of green, periods of grey, and periods of red. Where it's green, the trend is bullish. Where it's red, the trend is bearish. And where it's grey, we're in this area where there's neither a bullish trend or a bearish trend. It's more of a sideways market. So if you look at current price action, you'll notice that there's periods of red and periods of grey, which is confirming that we're not fully in a bear trend. We want to see more sustained red. If you look at this bull trend from last year, you'll notice how much green there is and then just bits of grey in between. That's what we're looking for in a confirmed trend to the downside below the 200 moving average, but we want the trend filter, of course, to be red. So again, going back to the monthly time frame, we have the low of last year below current price action, and we've also got the 200 simple moving average below price action as well. So that could potentially end up being a very strong support zone where price could bounce off that and move back to the upside. So if you are looking to short the market, you've got to be aware of these levels. Whether you believe in technical analysis or not, you've got to give technical analysis a chance. You don't want to dismiss technical analysis. There's a lot of talk out there of technical analysis being hocus pocus, particularly if you come from that Warren Buffett school of thought, which is value investing. Warren Buffett, over his years of investing, has made 20% a year, which is phenomenal. It beats the banking system. However, if you look at technical traders, people like Richard Dennis, if you're not familiar with Richard Dennis, I recommend reading Way of the Turtle by Curtis Faith. Richard Dennis made, on average, I believe it was 110% a year using technical analysis and trading long-term trends. So the idea here is that you use charts like a trader, but you hold your positions like an investor. So you really marry the two. Look at the charts to find your opportunities, but then still have that investment philosophy where you're holding your positions for weeks and months, potentially even years. That's really the best approach for us as busy everyday people, because you can then adapt that approach around your lifestyle. Remember, guys, you're busy. You've got hobbies, you've got careers, you've got families, kids, pets. There's things that you like doing. Ultimately, it's called a life, right? And you want to be able to get on with life, get on doing what you're doing, but you then want to be able to manage your portfolio around your lifestyle. And that's really where technical analysis comes in. Now, if we come down to the daily time frame, the daily time frame paints a very interesting picture, because price is below the 200 moving average, it's below the 50 simple moving average, and it's below the 200 simple moving average. So we've got the 200 simple moving average, the 50 simple moving average, and the 20 simple moving average. All very useful moving averages on the daily time frame. And if you notice, Thursday, Friday, and Monday, these three bars, quite a drop. I mean, from the close of Wednesday, you're looking at a drop of almost 9%, 8-9% in 3 days. And you'll also notice as well, guys, how there's a gap between Thursday and Friday. There's a gap between Friday and Monday. So quite a rapid drop, and in line with really what's been happening since the start of the year. Trend, pullback, trend, pullback, trend to the downside, pullback, and now another move to the downside. Again, if you don't have a plan, if you don't apply patience, you could quite easily jump into these positions and they could still end up going against you, because there isn't a clear edge in the market. We want to have a very clear, defined, high probability environment where we have more chance of making a profit than a loss. Often this is lacking from people's approach. They tend to just jump in, getting caught up in the noise and the momentum, and that can then end up going against you. So, even though we are seeing these moves, we still want to be a little bit cautious, because, as already mentioned, highlighted the low of last year, and then of course the weekly 200 moving average. If these levels are broken, guys, then we're in a very clear market where we could potentially look to short the market, because we're below key indicators. We're below the low of last year, below the 200 moving average, already below these three moving averages. The trend filter is red on the weekly, it's red on the daily. So the market is suggesting that there is further bearishness on the cards. However, that is not guaranteed until the market actually dictates that. So at this stage, ideally, you want to be applying patience. You certainly don't want to be buying into stocks. Looking at buying into stocks, we can see that the market's heading down. You don't want to be buying into stocks until the market dictates that there is momentum to the upside. Now, how can you dictate that? Well, let's look at the daily time frame. we got moving averages. These moving averages act as resistance. So price could come up to the 200 moving average and then bounce back down again. If it moves above the 200 moving average, it moves above the 50 simple moving average, then we're starting to see bullishness. If price breaks above the 200 moving average, that is a very clear indicator that we could be seeing strength to the upside. Again, that's not guaranteed, guys, because we saw that here back in March, where price actually moved above the 200 moving average and then fell. So we are very much in uncertain territory here. At the very earliest, guys, if I was looking to buy into the stock market, it would be above the 200 moving average. If I'm looking to short the market, as already mentioned, I'd wait for the 200 moving average to be cleared, the low of last year to be cleared, and that's when I would start looking to short the market. So for now, we're neither bullish 100%, we're neither bearish. Shouldn't say 100% because it's never 100%. Let me rephrase that. When the odds are not in our favor to go long in a bull market, the odds are not in our favor to go short in a bear market. Right now, we're in this no man's land where we're waiting for price to dictate a clear direction. Okay, I hope that helps, guys. So again, once again, guys, if you like today's recording, don't forget to like, subscribe, hit the bell notification. And if you'd like access to this chart setup, go down to the link in the description, click on the link. The link will open up to this scorecard. Take the scorecard, guys. It's 21 very short questions that will take you less than 2 minutes to complete, mostly yes no questions, and this is all about your current stock's performance. Whether you have a portfolio or not, this scorecard will give you a very clear idea of where you are right now and what you need to do. Now, on completion of the scorecard, you will also get 30 days free access to our hot stocks vault. So this is where we scan the market for you and share the 10 best stocks that are outperforming the market. That could be either in a bull market or a bear market. At the moment, we are still kind of bullish as the overall trend is bullish. So most of the stocks that are appearing in the hot stocks list have more of a bullish bias because there's plenty of stocks out there, particularly in the energy sector, that are creating new highs and that are outperforming the stock market. We share those stocks with you, saving you thousands of pounds annually in scanner subscription to costs. In addition to that, guys, if you, as already mentioned, if you want access to the chart setup that I've used in this recording, you will have access to that as well in the trading view section. So guys, once again, like, subscribe, hit the bell notification, go down into the description, click on the link, complete the scorecard, and come through to our hot stocks vault. And I will see you in the next recording.